One of the top questions people always want to know is, should I pay down or pay off my mortgage early, or should I invest the difference instead, maybe for retirement or other worthy goals? And this is something I love to discuss with my clients because I used to be a licensed financial advisor. And so this is just, a topic right up my alley that I like to talk about. And it really comes down to your risk tolerance, what your mortgage rate is, how many years until you retire. There's many things, as part of that decision-making process for you. Know this, back in the 70s and 80s, your parents or maybe your grandparents used to have what were known as mortgage burning parties. When people paid off their mortgage, it was a big event. Because back then, mortgage rates were often in the double digits, like 10, 12, 15, even 18%. So paying off your mortgage early was a great financial decision back then. Now today, it's a different story, especially if you have a rate in the 2s or 3s from the last couple years. Probably almost always you're going to be better off saving the money, saving the difference, and investing more money for retirement, or if you have kids, for their college savings plans. Like for example, in 2020, I had a veteran who bought a home. I got him a VA fixed 30-year fixed rate at 2.25%. And he asked me, Lonnie, should we put some money down from the sale of our first home? And I said, no way. Instead, I want you to use that money, maybe help your wife pay off her higher interest rate student loans, or just start a Roth IRA for yourselves and start saving more money for retirement. So let's use this example. You're 30 years old, buying a home, okay, and you're going to have a mortgage rate, right now in the 5s, okay? Should you, pay down your mortgage early, or should you invest the difference? Let's assume you have an extra $300 a month that you can either use to pay down the mortgage balance quicker, or you could invest that money, okay? You're 30 years old. Let's say, assume you're going to retire at age 70. So you got 40 years to go. If you had invested that money, that $300 a month for 40 years at 5.5%, you would have saved over $500,000. Let's say you had earned 7.5% on that money. You would have saved about $900,000 by year 40. And if you were to earn, say, 10%, which is what the stock market has averaged for the last 50 years, when you include dividends being reinvested, you would have about $1.9 million saved in 40 years. Now, yeah, you could have done the $300 a month extra, and you could have paid off your mortgage 7 years early. But what would you rather have, a mortgage paid off or extra money, quote, in the bank? There are 3 downsides with paying off your mortgage quickly. One is you have less money, in the bank, or in this case, like a Roth IRA, to use to make the mortgage payment in case you get into a problem, a crisis. Maybe you lose your job, maybe you get disabled, maybe you come down with cancer, whatever the case may be. If you always pay down the mortgage balance, you'll have less money in the bank to help you make the payments when you really need that money, okay? Number 2, and people don't realize this, but if you pay down your mortgage balance faster, you actually have more risk, greater risk of foreclosure. Because your lender knows that if you have more equity, it's going to be easier for them to foreclose on you if you don't make your payments on time, because they know they can get repaid. So you're actually more at risk of foreclosure if you pay down your balance faster. And so we saw this during the Great Recession, where millions of people were able to, quote, keep their homes because they had no equity. And their bank, their mortgage lender, knew that. So they were waiting to see if their equity would come back before they foreclosed, whereas people who had equity were the most likely the ones who lost their homes to foreclosure during that time period. A third detriment, to paying down your loan balance quickly is that equity in your home is basically worse than money underneath the mattress. It's not making you any money, and it's difficult to access. The only way you can access it is by doing a cash out refinance on your mortgage or getting a home equity line of credit or HELOC. So you have more danger if you're focused on paying down the loan balance. To me, you're better off focusing on growing your assets so that in case something happens, you have additional money to make the payments. But if you have, questions or want to run some scenarios by me, please feel free to text me. I would love to talk numbers with you. My number is 303-881-6374. And feel free to share this video with others, even those who may totally disagree with me. Share it with them. This could be your parents, your family members, but share this, with them. Share this with your friends and younger family members too. And please subscribe to my channel so you can receive great information like this every week.